you don't mind, who are the most likely to utilize these tools?
Candidates for interest rate caps or swaps are anybody that's borrowing money.
Well, Kevin, thank you for coming on today. Talking about rate swaps and caps, a little over my head. So I really, preparing for this video, I did a little research and I'm like, okay, well, I'm glad Kevin's coming on to explain this all to us because I got kind of a general understanding of it. But I'd like to get a kind of a deep dive into it and how, as an investor, a real estate investor, we can utilize these tools. So thank you for coming on.
Sure. No, thanks so much for having me. And this is a thrill for me. I have enjoyed your podcasts or uh, uh, Zoom calls.
Yeah.
And impressed with the wide variety of guests that you have on. So you're covering a lot of topics and certainly ones nobody can be an expert in all of them. So appreciate the opportunity to talk.
Well, it's fortunate that I don't have that much knowledge, so I've got a lot of questions to ask. It really helps being where I'm at. And also I've got George Pino on here. George wanted to be part of this because with Commercial Brokers International, he runs into this occasionally. George is the CEO of Commercial Brokers International in Los Angeles. So George, thank you for coming on as well.
Yep. And thanks for having me on as well.
Yeah. So I think let's just dive right in. Kevin, if you kind of give us, what is, the difference between a rate swap and rate cap?
Sure. So an interest rate swap, the basics of it is it's a swap, an agreement to swap or exchange interest payments. And it's typically an exchange of fixed for floating interest rate payments over a certain period of time based on a set amount of principal, which we refer to as the notional principal. So the most common use is borrowers that have floating rate loans that want to convert it to a fixed rate. They can enter into an interest rate swap to swap it for a fixed payment over a certain period of time. So it's a separate contract from the loan, and under the contract, usually the bank that offers the swap will, let's say, use the example of a floating rate loan. They will pay the counterparty a floating rate interest to offset the loan payment, and then the borrower or the fixed rate payer pays a fixed interest payment over that same period of time. And so from the borrower perspective, the floating rates cancel each other out and they're left with the fixed payment over that term.
Okay.
To simplify things a little bit, there's not actually two checks floating through the mail, one for floating, one for fixed. They just net those two payments out each month. And so, for example, if the fixed rate, let's say on the swap was 5%, and let's say the floating rate, let's call it SOFR, is 4%, they would pay under their loan 4% plus their credit spread. And then under the swap, because the floating rate's below the fixed rate, they're going to pay another 1% on the interest rate swap. So it'll net their effective SOFR or variable rate index up to 5%.
Okay.
And so their all-in cost would be the 5% fixed rate plus the credit spread. Now, when things flip and the floating rate's higher than the fixed rate, let's say SOFR goes to 6% and the fixed rate's still 5%, they're going to pay 6% on the loan plus the credit spread. And then under the swap, they'll actually receive the difference, the 1% difference between the 6% variable rate and the 5% fixed rate. So again, their all-in cost nets out to 5% on the variable index plus the credit spread. So if you think of the swap as always a balancing mechanism between the variable and the fixed rate to net the borrower out to the fixed rate.
Okay.
On the interest rate cap side, that's really more like insurance, right? So if you think about buying insurance on your home or your car, or in the case of commercial real estate, your building, You're going to pay an upfront premium for that insurance. And then the premium is going to be based on a few factors, but one big one is the deductible, right? The
Right.
lower the deductible, the more expensive that insurance is going to be. Interest rate caps are very similar in that your deductible would be equivalent to the cap rate. All right. So the higher the cap rate, essentially think of it as your deductible again, the less expensive that cap is going to be. The lower the cap rate, the more expensive it's going to be. Caps, as I said, are paid for upfront. So the difference is the borrower has a floating rate loan. They're going to buy a cap as a separate contract. They pay for it up front, and then nothing happens until the variable rate exceeds the cap strike.
Okay.
So the borrower gets all the benefit of rates staying low or going lower because their loan will still float down. But then as variable rates go up, they'll have protection. So using those same kind of thresholds, if you will, of let's say a 5% cap in this case, if the variable rate's 4%, then they're going to pay 4% plus the credit spread under the loan, and they won't receive anything under the cap because it's below the variable rate's below the cap strike. If the variable rate goes to 6%, they're going to pay 6% plus the credit spread under their loan, but they're going to receive the difference between 6 and 5, the cap strike under their cap. So it's going to net them out or cap out their all-in interest cost in that case.
Okay.
Well, Kevin, I had a quick question if I could just step in here.
Go ahead.
On a cap rate lock, now is that typically for the life of the loan, or is it just going to be for certain periods of time, or can it be both?
Yes, so great question. And that's one of the real advantages of both caps and swaps is they're fully customizable because they are separate contracts from your loan agreements. So they can be for less than the full term of the loan, both a cap or a swap. They could also be for less than the full amount of the loan. So if you wanted to convert half of your loan to fixed, you could just swap half of the principal amount of your loan to a fixed rate. So if, let's say you had a 5-year loan for $10 million, you could swap or cap half of it, 5 million, for 3 years, and essentially have that exposure the last 2, and that can be an attractive alternative if a borrower wants the longer term liquidity of a longer term loan, but really only expects to own the property for 2 or 3 years, for example.
Okay. Well, help me understand this if I may, because honestly I don't know. On a cap rate lock that is expiring prior to the term, let's say it's a 5% cap rate lock, but then current interest rates on the variable side are at 6.25, but you're at that 5 because you're getting paid back. Now, when the cap rate lock expires, typically speaking, when you're in a variable rate loan, they can only raise it a certain amount per quarter or per period, whatever that period is negotiated out. Does that automatically jump to what it would have been without the cap rate lock, or do you start at where the cap rate lock was and then it starts adjusting upwards at that point? Or is that all negotiable?
Yeah, so in that case, let's say it's a 5-year loan and you capped it for 3 years. At the end of the 3 years, the cap expires, and so you're just left with the loan. So what your rate would be at that point is going to be based on the terms of the loan by itself.
Okay.
And so you wouldn't have that protection. What we've seen happening a lot in the last year is borrowers with, say, 3-year bridge loans, they only bought caps for 2 years, expecting that they would have refied out within those 2
Yeah.
years. And of course, with the change in the credit environment, that's been more difficult. And so they've had to extend their caps in that case. So yeah, if at the expiration of the cap, it just goes away and you don't have any protection at that point. And so you have to either negotiate a new contract to hedge the remaining term of the loan.
So you might have a huge increase then, a huge increase potentially,
exactly.
given this environment.
Exactly. Yep.
Kevin, if you don't mind, who are the most likely to utilize these tools?
So really, candidates for interest rate caps or swaps are anybody that's borrowing money, typically on a variable rate basis. So, obviously we see a lot of commercial real estate clients that are either required to buy caps on variable rate bridge loans or agency loans, or they choose to. Obviously, they want to have that protection. Same with bank loans that are variable. In some cases, the bank requires them to enter into a swap or cap, or they choose to. So candidates for swaps or caps really think of it as just another way to achieve a fixed rate loan or to have protection against variable rate exposure on your debt. So, one thing we'll look at as advisors and consultants with clients is what is their exposure to variable rates on the revenue side. And some businesses have their revenues are exposed to changes in the economy and thus interest rates as well. And so as the economy booms and interest rates go up, their revenues increase, vice versa. As things contract and slow down, rates come down, their revenues come down. And so in those cases, variable rates might be the best hedge, if you will. And fixed rates might actually give them add risk to their overall income.
Right.
And so that's really a big consideration in terms of whether somebody should be floating or fixed, or in most cases, some sort of mix, have some balance.
Yeah, but this is your average small investor that has a couple properties. They're typically not getting into this, though, are they? It's more typically your more sophisticated investors that understand the risk and have the ability to work with it.
Yeah, so these products are available to the middle market and smaller investors, typically, deals a few $1 million and up.
Right.
Would be good candidates. I will mention on interest rate swaps, because there's an obligation to exchange payments, meaning that the borrower is obligated to potentially make payments for a long period of time. There's a credit component to that product. And so the bank or the counterparty that's offering the swap will have to underwrite that credit risk and get that approved. Thus, in most cases, the swaps are only offered by the bank that offers the loan as well, and they'll cross-collateralize that risk.
Gotcha.
So financial institutions that are non-banks and offer variable rate loans, they'll usually the borrower will have to go get a cap because they can't get that credit risk underwritten by a bank that doesn't have the other collateral involved.
Yeah, I think mom and pop, because when you're sitting there doing your taxes at the end of the year, putting all that together, that would be a little bit complicated. How's the business going right now? Is it gangbusters right now, or is it slow? Is the economy slows a little bit? You guys are seeing a slowdown?
Yes, so certainly part of our business is tied to loan volume.
Right.
And so as that is slowed, and certainly the loan volume can also be not just tied to new development, but acquisitions as well. So as loan volume is slowed,
Yeah.
new transactions have slowed as well. However, we're doing, as I mentioned before, a lot of work on extensions
Right.
and helping clients hedge risk. Obviously, borrowers have become all too aware of their risk to rates rising, and thus become much more interested in hedging that risk. And so we're doing a lot of work with clients with existing loans, saying,
Right.
how can I protect myself? There are also opportunities now that it appears that the Fed is about done or is done raising rates, to think about the next cycle, and
Yeah.
what happens when rates come down.
Yeah.
And so we have seen some clients thinking along those lines.
Yeah.
And also a lot of those variable rate loans that they booked in the last 2 years had embedded floors in the variable rate in the loan. And so we've seen some interest from borrowers coming to us saying, can I buy a floor to take advantage of falling rates, which you can do as well.
Yeah, that brings regulatory considerations. I mean, it's with what we're going through right now. What do we really have to be watching out for with this?
In terms of regulation,
Yeah.
the bigger issue, I think, is well, certainly we had a huge shift in the regulatory scheme after 2009 and the
To say the
passing of
least.
Dodd-Frank.
Yeah.
So things changed significantly
Mhm.
on the regulatory side from that. Frankly, I don't see a big change in that unless we see a large wave of continued bank failures like we saw earlier the year with
Sure.
SVB and those folks. So the banks seem, knock on wood, fingers crossed, fairly stable at this point.
Yeah.
I don't foresee any big changes on that side. But the bigger things to look out for is the credit environment. Will
Yeah.
it continue to contract, or are we kind of hitting a plateau or bottom, depending on your perspective on that? And are we what are we going to see in terms of a shift from the Fed, from a tightening to a
Right.
potential easing standpoint down the road?
What will it, if and when they, I keep hearing all this, the end of 2024 now, we're going to be easing rates. And somebody was even talking about April of next year. I don't know when it's going to be, but when and if they do ease those rates, what's that going to do with the business?
With our business?
Yeah.
So, yeah, I mean, that's the $1 million question, right? Is if and when the Fed starts to lower rates.
Right.
And that outlook has changed dramatically over the last several months. Earlier this year, this summer, the market had priced in, I think, about 6 Fed rate cuts in 2024. Now that's closer to 3 next year, and really not starting until the middle of next year.
Yeah.
And that's the thing with our business and trying to hedge rates. First of all, we advise our clients, we're looking to protect and offset risk in your business, not speculate on interest rates. And our clients have been very successful, and your clients, I'm sure, as well, in their business. And their business has nothing to do with betting on interest rates. It has to do more with building great buildings and leasing those up and attracting tenants, if you will. or if they're on the commercial or corporate side building widgets or whatever it is, it's not speculating on interest rates. So first of all, let's not try to get into that business. Secondly, though, there's always opportunities in the market, in the interest rate marketplace, and windows to put on attractive hedging structures. So regardless of whether rates are going up or going down, there are opportunities, and those opportunities are built by the market's expectations and the forward rate curves. And along those lines, the forward rate curves are always wrong, right? So just as I mentioned, the forward rate curves, the market predicted that rates are going to fall dramatically next year. Now they've changed that completely. Maybe they are going to fall dramatically next year. Nobody knows. But if you have exposures to falling rates, let's talk and talk about solutions that can help you offset that risk. If your exposure is to rates going higher, now's a pretty good time to be looking at hedging that, because the market's not anticipating that rates are going any higher, or much higher. And so there's certainly ways that we can pretty cost effectively manage that risk.
Beautiful. Well, and I'm going to tell everybody that's watching, if you have any questions for Kevin, put it in the comments. Also, Kevin, I'm going to put your contact information below on the video. But George, did you have any further questions?
No, I mean, I think Kevin actually covered a lot of my questions I was going to ask about, for the details, what it requires. You know, I think just to be clear, you know, with the swaps, you know, I know Kevin had mentioned that the banks or the institutions are going to have to underwrite and looking at potentially cross collateralization. And I think the easy explanation for that for some of our viewers that may not have a lot of experience with the swaps is that, you know, typically you have deposits at the bank that you're either invested, or they're giving you something on a long-term or short-term basis. And that's what they're using to cross-collateralize, typically speaking, and using the interest that you're earning off that to adjust on the swap.
Yeah, and George, I
want to make sure I was right.
Yeah, you know, really the value we add to clients that are considering swaps is bring in a third-party expert, an advisor or consultant that can look at the contract that's being offered and the pricing that's being offered by the bank, and we can verify that and keep the bank honest on their pricing. That's huge. Even a few basis points is a lot of money on these. Mm-hmm. So if we can keep them honest on that, that's one thing. The structuring is big as well. You know, the banks that offer these swaps, regardless of what they tell you, they're doing it for their own interest. And so that's not necessarily aligned with the borrower's interest. And so understanding the borrower's goals for the property, their hold periods, etc., not just the property, but the debt as well, will dictate really the best structures for them. And then thirdly, you mentioned the cross collateralization, the review and negotiation of the contracts that are behind the swaps. So they'll be required to sign what's called an ISDA and ISDA master agreement, and a schedule to that master. Regardless of what the bank tells you, those can be negotiated. And so making sure that the boilerplates are very one-sided in the bank's favor. So making sure that they're signing what's appropriate on that. And you know, we equate our services to you know, attorneys and accountants. You know, certainly you know, a bank puts a package of loan documents in front of a borrower and say, sign these. Sophisticated borrowers are going to bring in an attorney to have them review that.
Absolutely.
So we offer those same kind of services in terms of,
Mhm.
you know, have an expert, have a professional review it, make sure that
Okay.
you're signing something that is appropriate to you in the market, and getting pricing that is aligned with the market, and a structure that is geared toward your goals and risks, not the bank's.
Makes
Great.
sense.
Great
Yeah.
question, George. Well, Kevin, thank you very much for coming on today. I know we've taken quite a bit of your time, so I know you're busy,
Yeah.
but I appreciate you giving that. Can you tell us how we can contact you?
Sure, absolutely. So again, it's Kevin Morse, Morse. I'm with Derivative Logic, and our website is derivativelogic, all one word, .com. And my email is K as in Kevin Morse, Morse at derivativelogic.com.
Beautiful. And we're going to put that down below in the video so they can find you.
Awesome.
And again, if any of you that are watching have any questions for Kevin, please don't hesitate to ask, and I'll make sure that he sees them. Kevin, thank you very much. Appreciate you taking
Sounds
the
good.
time.
Love what you're doing, Joe. Thank you so
Thank you.
much. And George, appreciate your time as well, and look
Yeah.
forward to
Well,
working
thank
with
you for
you
having
guys.
me on. Yeah, this was
Yep.
really good. I learned a few things as well.
Yep, it was
That's
educational. I appreciate it. George, thank you for coming on today. And
Absolutely.
for those of you watching, thank you for taking the time to watch us today. Again, don't hesitate to reach out to Kevin or put the comments below. And if you could, please give us a like. And if you haven't done so, make sure you subscribe.
Yep.